All right, good afternoon, everybody. Um, if someone could help me out and pop on the YouTube and make sure that my sound is working properly over there. Yeah, I'm just back on a computer setup I haven't used in 6 months, and something inevitably breaks when I do that. And I'm on a different microphone, and it was giving me an issue. It sounds fine. Look at me. Look at me. Future tech guy here. All right. I'm an associate member of T3 Trading Group, which is an SEC registered broker dealer and member of FINRA. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. Josh has jokes. Only real position update is I got out of my SPIR long that I had been in for a while. Got up to 1250. And I'm no longer in it. So I was able to make some bucks in that one. All right. So let's jump in here. The market's down small after hours, including that small downtick after hours. Spies are now actually flat green. We closed small positive in it. Got hit a little bit into the close. Not sure if that was just some natural selling into the close. It seemed like that headline of the 500 Marines have been mobilized to respond to LA protests downticked us really small as well. I don't know if that's necessarily going to be market moving unless it turns into something really insane, um, which I hope it does not. Hughes here, also down about, I don't know, 40 cents after hours and closing green, flat green, but green all the same. And the IWM was our leader today. Rolled over heaviest in the last hour, but the IWM is our leader, up 0.7%, which is what I would expect to see at this point if the continuation of this rally is turning more into shorts being squeezed out than new longs being added. We could circle back to that thought process in a second. TLT was up a little bit, but had a decent red to green move. Gold was up a little bit. The dollar was down a little bit. I think Bitcoin close. Wow. Bitcoin was on fire today. Absolutely on fire. Huge move higher than Bitcoin. All right. Let's review today's trading session with an eye towards how we were reviewing things in the morning meeting. I'm going to start by pulling up Pat's note again from this morning that had some really good information in it. So first of all, just real quick, short-term tactical as of Friday closed in the red zone for the first time, which I was a little bit surprised at because Friday was a relatively quiet, tight day. It was mostly a consolidation day. Um, mostly a consolidation day, and we didn't close on highs either. I was surprised to see short-term tactical close in the red, and the way that I typically measure extension, which is at least $10 off the ADMA, $10 above the ADMA in this case for the spies, we were not really anywhere close to that. So the upside extension not really showing itself in the daily chart at all, but for some reason short-term tactical closed in the red. So short-term tactical close in the red again does not necessarily mean to me to short. It typically means do not buy. Sometimes we get multiple days of it being in the red in a row. But usually what ends up happening, if that will happen, where you get multiple days of extreme short-term tactical in a row, so you go sideways for a couple hours, half a day typically, and then you end up having a strong afternoon session and closing really well, which didn't happen. We tried to have the strong afternoon session, but we closed poorly. So I'd be surprised to see short term tactical back in the red again tomorrow. But that wasn't the most important part, I thought, of Pat's note. So real quick, S&P Gamma. I just want to note this as per Bank of America note, I believe, is long $1.7 billion. So not a huge number compared to what we were seeing at points in 2024, but will have a little bit of an impact of reducing volatility and keeping things a bit tighter as we get $1.7 billion of buying into a down move and $1.7 billion of selling into an up move. But Most importantly, I thought from Pat's note this morning came out of JP Morgan. We've been seeing a lot of this data recently about hedge fund gross exposure versus hedge fund net exposure. It's not really something I've spent too much time looking at previously, but gross exposure would be basically if you added their longs and their shorts together, whereas net exposure is the net amount, right? So you would take the longs and subtract it by the shorts. So the gross exposure numbers have been very, very high, even though the net exposure numbers haven't been as high. And that number, the gross number, has stayed pretty high. So what that means is, again, the funds, as they've been adding longs, right? We know that they've been adding longs for a few weeks now. A lot of like stop ins on the upside as the market moved higher. They're also maintaining their shorts, so their shorts really haven't seen too much squeezing ongoing, at least not yet. Started to really notice this data at the end of last week, but this was saying. What's a bit surprising about the recent flows is that the buying has come mainly from hedge funds adding to longs rather than covering shorts. This is somewhat surprising because hedge fund gross leverage is still near highs. So basically, the indication of that is when we're looking at this market, going over to the daily chart now, so as I'm sure everybody knows by this point, and if you don't, you should. Um, I had pretty bullish expectations of where this market could bounce back to when we were even in later April, and it has exceeded those expectations. And this is how markets work, right? Markets work in feedback cycles. Buying leads to more buying, and that is what inherently creates a technical uptrend. And then in a down move, selling can lead to more selling, and that can create a technical downtrend. What's interesting as we have learned to understand and digest data better that comes from a lot of the banks, like the systematic buying, the hedge fund buying, the retail buying, all that stuff, is while I've always known that an uptrend is a pattern of higher highs and higher lows, and it's a feedback cycle of buying. What I've never really been able to notice as much is the cycle by which the different buyers are actually buying throughout the course of a trend. And I'm sure that every trend is a little bit unique on where the buying starts and where the buying ends. But this one has just been really interesting to see because we've been able to note, if you go back to the almost like in some ways like the last major pivot low on April 21st. There's been a few others on the way up, but this April 21st low, I remember us calling for a positioning squeeze, and the first like leg or two of that move higher was seemingly all systematics, and it was almost like a trade-off. It was like CTAs and then vol control and then CTAs and then vol control. Obviously, simplifying this a little bit because there's always a dynamic of both buying and both selling at the same time. But it seemed like it was the systematics. And then and retail has been just nonstop buying, by the way. And then at a certain point, the hedge funds seemed like they were coming in late and they were being stopped in on the long side. And the interesting part about that data is at a certain point, we saw the systematics begin to kind of run out of gas a little bit. And by run out of gas, just to, I know I say the same things a lot, but it's all important. But run out of gas, I don't mean that they ever really stopped buying. It's just that it's significantly slowed down. And I would say it's significantly slowed down, probably starting in mid-May, probably right around this last squeeze week here is when the systematic buying was slowing down. Not going to zero. We do have small systematic buying coming from vol control, small coming from CTAs, I think in a flat or an up tape, but significantly less than that earlier squeeze. And as you can see, once the systematic bid slowed down, so did the speed of the uptrend. That's not a coincidence. But yet there's still been a very strong underlying bid that has held this market up, and every small dip has gotten bought, every piece of bad news has gotten bought, and that has seemed more like hedge funds adding back exposure, especially on those dips because they had been underperforming. But then now we turn back to the data that I was just talking about the gross exposure versus the net exposure. And as you can read there in the JP Morgan note, the interesting part about the hedge funds adding back to their longs is that they had been primarily adding back to their longs and getting back in longs, just generally speaking, without covering shorts. That's why those gross exposure numbers have gotten so large. So now, really starting at the end of last week, I started to ask myself, I was like, all right, well, let me ask myself the same question again: is who is left to buy? It's not systematics. I mean, it is in a small way, but not in the way it was. It seems like the hedge fund long exposure has gotten pretty long again, where they might be beginning to run out of juice. We do still have corporate buybacks that are buying every day. I mean, there's pockets of it, right? Corporate buybacks are still really strong, a little bit from the systematics. I'm sure it's a little bit of additional long buying from the funds. When you look at those numbers, it's like, all right, the real last place left where I think where you can see some major buying coming in is actually more like short covering, because there were other stats I think from a couple of Pat's notes late last week that were showing the overall S&P short percentage is the highest it's been since I think 2018. And if you really look at the look back chart, though, getting us back to where it was in 2018 actually feels more like a normalization of S&P short float than it does like a real outlier of statistics. Like, oh my God, everyone is so short the S&P. I don't think it's that way. I actually think it's just kind of more of a return to a pre-COVID normal S&P short amount, but it is still notable that it's the highest it's been since 2018 when you combine that with the hedge fund gross exposure stuff that we were just looking at. So at the end of last week, on Friday, I believe it was, we saw the IWM breakout. The IWM has been the real laggard throughout pretty much all of this. They suffered the most from higher interest rates. They just don't have the buybacks that a lot of the Mag 7 companies have. So just a lot of underperformance from the Russell. And then all of a sudden that started to break out, that started to squeeze. And I feel like it's two things kind of ongoing at once. One is this is one of the places where you can see some of the short squeezing activity that's starting to happen, that kind of last leg of potential buyers that I'm talking about. But I also think it's a place for underperforming managers to try to chase what's been lagging a little bit, because when these IWM names run, they can run really big. So I think it's like kind of a combination of short squeezing that's occurring there with catch up long trades that are ongoing at the same time. And you saw that with the IWM outperformance on Friday and it beginning to break out. And you saw that with the IWM continuation and relative strength today, even in the face of pretty high overall interest rates. So it seems to be what is occurring now, and you can see it in all these little stocks, all these kind of crappy names that are starting to run also, which I keep saying that tends to indicate that we're closer to the end of a cycle than the beginning of a cycle. We we have seen this happen many times now, actually, since the late 2020, early 2021 period. And that late 2020, early 2021 period was like, honestly, it was like the biggest bubble in stocks I feel like I've ever seen in my 15 plus year career. And we knew it at the time. So the valuations that these things were trading at was insane. The SPACs, the crappy IPOs that were getting listed day after day after day in that environment, taking advantage of this post-COVID liquidity bubble era that we were in, where everybody was chasing everything. We have seen further pockets of that a whole bunch of times since the big bubble in late 2020, early 2021. But every time it's relatively short-lived. What does that mean, relatively short-lived? Just going based on memory here more than anything. Relatively short-lived means you see those things begin to squeeze, and sometimes it's a matter of a few days, sometimes maybe it's a matter of a few weeks, and then we end up having kind of a near-term top in the market and at least some degree of a rollover, or we can't continue higher. So you're seeing it in the IWM. You're seeing it in a lot of those stocks. And we're seeing on Friday Fuel Cell beginning to run. Fuel Cell was up another 16% today. I mentioned it really briefly in the morning meeting. I don't know what it is about Fuel Cell and Plug in particular, but these companies have both been around for a long time. A lot of these other squeezy names, like didn't we see Workhorse begin to run today? Yeah, Workhorse had a 12% up day. I haven't, I forgot that this company even existed until someone mentioned that they saw it squeezing. But for the most part, these companies weren't really around. A lot of the workhorses prior to that. And look at the Google. Like it's and I look at workhorse. I can't even get to the top of this. I need to try to zoom in on my chart. I'm sure that this thing has had splits and everything else. Yeah, look at this. Workhorse, this is how crazy the market was back in early 2021. Workhorse was a $10,500 stock or whatever. And now it is having a big 8% up day that got it up to a dollar and a cent. Just absolutely insane. But plug and fuel cell, I feel like I've been seeing these names be crappy stocks and have these occasional speculative squeezes for like as long as I've been in the business. And I notice it every time. Like, oh, they're starting to run fuel cell. We got to be close. And they started running fuel cell on Friday. They ran it further today. It was a big move. This thing was just a $4 stock. I mean, earlier this month it was a $3.50 stock. Today it broke above eight. Um, that's gotta be. I can't say it for certain, and I don't know what the short float is in these stocks. I didn't look it up, but that's gotta be the short squeeze aspect of things coming in. And I know Plug had some news today, so maybe it's not the best example for today's story specifically. I think there was an insider buy in Plug. It's what Pat was saying, but still, Plug up 27% today. So when you're seeing the IWM run, you're seeing the workhorses run. It's like, okay, that's gotta be some degree of short squeeze activity that's coming in. This tends to be late cycle stuff. And if you're wondering, who's left to buy, which is what I have kind of been asking myself, it's the shorts that are getting squeezed is kind of who needs to buy. And you can see that in the IWM. Now, with all of that said, I'll say the same thing that I've been saying since we successfully predicted the market breakout on Tuesday of last week when we got through SPY 595 and we got through QQQ, what was it? 523, right? Yeah, 523. Um, we saw the breakout coming on that Tuesday. We called it perfectly. The market set up technically beautiful into that breakout, and it's been grinding higher ever since that breakout for the most part has began or happened, with the exception of Thursday, a little week when things last week when things got a little bit disrupted with the Trump Elon tweet back and forth that occurred. Um, so this market just kind of continues to squeeze higher and looks it looks beautiful technically. So the thing I keep saying is there's 1,001 reasons why you might want to be short this market. Fundamentally, uh, you could say it's expensive. The market's expensive. You could say that the trade war is going to hurt the economy. You could say anything you want to say. You could look towards some of the stuff that I was just talking about. There's not really anyone left to buy. They're buying up the workforces of the world, which means that we're super late cycle. That may all be true, but first of all, I might not even be right. I'm saying that them buying up the workhorses is late cycle. For all I know, it could just be part of a rotation. That was part of today's question with the IWM is this a rotation? Where now the IWM is starting to go, which could be healthy. In a really healthy market, the different indexes and the sectors, they take turns. One sector runs, it gets extended, it pauses, the next one goes, it gets extended, it pauses, then the first one goes, and they just trade back and forth and back and forth, and that's part of a healthy market. So I might not even be right, but assume for a second that pick your bear thesis is correct. Let the technicals prove it to you. Let us come back through a breakout level. Let us get an upside tail that you could be short versus. You don't need to short the absolute high to the penny if the market is going to give a big pullback. And again, those are all ifs. I'm starting to think because I always try to think out like a few months, and then I reduce and I adjust as time as we get closer to those days. But I'm almost starting to think that like a real market pullback at this point almost has to be like August to September period. And guess what? August and September are the two weakest months seasonally. And while June is the third weakest month seasonally, it does typically end small positive, and we still haven't seen any degree of deterioration of economic data, which is, I think, the potential thesis catalyst that could bring us down. There's been no deterioration there. The jobs number on Friday came out really good, and the soft data numbers, which haven't been as good, have been ignored by the market. So whether it is an economic data situation that brings us lower or whatever, what we've seen so far, and it's been incredible, is the market just ignores any and every bad piece of news. We had, I think, five important economic numbers last week, and the first three of them were bad, basically. Well, so we had ISM, manufacturing was not good. Jolts was fine. Services was bad. ADP was bad. Unemployment claims on Thursday, which isn't as important, was bad. And then we had finally we had a good number on Friday. It's matter. Every bad economic number I mentioned was just completely ignored by this market and brought back up. So, the bottom line is, can we go lower? Yeah, we can go lower, but you don't need to throw it from the absolute high to the penny. You can throw it on the way down. That tends to be better when we're seeing a trend break, when we're seeing some previous levels get lost, when we're seeing a breakout failure, or even when we're seeing some degree of massive upside extension and a parabolic move with the shooting star. That's when you can get short instead of just fighting and fighting and fighting this market that refuses to go down. And today was another example of it with Apple, honestly. Apple is it the third largest market cap now after Microsoft and Nvidia? I'm not 100% sure. I know it's top three. They're always kind of swapping around. Um, but I mean, regardless, whether it's third or first, it's up there. And Apple got hit on that event today, which I actually thought that the risk was to the upside on the Apple event today, even though I have not been bullish on Apple at all. Apple got hit down. And what did the Qs do when Apple was getting hit down? Absolutely and utterly nothing. We went down for 7 minutes or whatever, and then V bottomed it and snapped all the way back. It doesn't matter. It's just the environment that we're in right now. While the gamma level, so I feel like this degree of dispersion I have learned to see in really high S&P gamma environments. The gamma environment here is not that high right now, but we're seeing that dispersion effect occur because there are other things, um, like Bill was talking about in the VTF a little bit. Bill K was talking about in the VTF a little bit at the end of last week. There are other things that can almost act as like a little bit of a substitute for that gamma that can insulate this market from giving those really large moves. And it just seems to be what's going on right now. It's like, okay, they hit Apple down, so something else has got to be going up to make up for it. And that is just that's just the environment that we're in. I mean, I really don't know. I was like chatting with Rock a little bit into the VTF at a certain point today, where it's like, let's say that you're, and I'm just kind of choosing a random Mag 7 stock. Let's say that you're short Amazon, right? If I was short Amazon and Apple was having an event, I would want, ideally, typically, for Apple to go down. Because if Apple goes down, it's such a big company, it'll drag the Qs down. And then if people are forcing themselves to sell the Qs because the Qs are moving lower, then that inherently means that they are forcing themselves to sell a little bit of Amazon. So, I don't want to say we root for stocks because it's the wrong way to think about it. We're not cheerleaders here rooting for our stocks to go up and down, though sometimes some of you guys here in the VTF act a little like cheerleaders, and you got to stop doing that because and I'm sure I do a little bit too. But it's just not healthy from a trading psychology perspective. But for lack of a better term, if you knew that there was about to be an Apple event and you just happen to be short, let's say Amazon, and let's assume for a second that that the companies don't have any relationship to one another with their businesses, you'd be like, okay, well, I hope the Apple event doesn't go well because it could pull my Amazon down a little bit, even though they're not similar companies. If the queues go lower, then Amazon will go a little bit lower. In this environment, I would say you almost don't know what to root for because it seems to be that if Apple moves lower, this dispersion effect literally means that Amazon actually has to move higher to make up for it. So it's almost like I'm short Amazon, so I want Apple to go up on the event. It doesn't seem logical on face value until you have a better understanding of market structure and particularly that kind of dispersion effect. So it's pretty much where we're at. I think it's a good overview of how the day was today. As far as individual stocks go, I lost a little bit of money short selling SOXL, but I made some money in short selling SMCI. I made more in SMCI than I lost in SOXL. I closed them both out by the end of the day. And I also got. Oh, I forgot to change that in my disclosure. I'm out of AMD. I meant to put that on. I am out of AMD. I'm out of AMD. I'm out of AMD. No longer in AMD. I got out of AMD at 120 in the opening up move this morning. Um, so yeah, I think that's pretty much all I got. Happy to take a look whatever you guys have. Where are we at here? So Microsoft is the number one market cap. It's barely ahead of Nvidia. They're neck and neck. And then Apple is rounding up the third place there on the chart. Thank you, Bill. Scrolling up a little bit to see if I missed anything. Try to take the questions in the order in which they come. Everyone likes how my voice sounds. That's nice. I hate how my voice sounds. I feel like everyone feels that way though when you hear your own voice on like a, dare I say, an answering machine. Do kids even know what answering machines are anymore? Oh man, you hear your own voice on the answering machine. You're like, oh man, delete that. Uh, all right, what else? From Dave S. I heard from another source that today was the lightest day from a volume perspective in the S&P composite in months. Okay, let's see if we can see that in the spies. A little bit of a lighter day on the spies. Looks like we had 2 days in May that were lighter. But yeah, a little lesser volume today. From Tate, if Elon and Trump resolve their tensions, could that lead to a bid in Tesla for a major higher low on the daily chart? Sure. And if they do make peace, would that pressure names like Boeing or ASTS, potential contract replacements as a result? Um, yeah, so the direct answer is yes. I think if you don't overthink it, if Elon and Trump resolve their tensions, then that's great for Tesla. And then these other companies maybe were overbought, right? We're looking at Boeing, we're looking at ASTS, we're looking at Rocket Lab, all as potential uh, benefactors, Uber to some degree, of the Elon and Donald falling out situation. So if it gets better, then it could actually absolutely replace itself. I mean, my kind of general thought process, if you want to know my general thought process on it, and someone who has a position in Tesla, is that I think that this is not good for Trump. So he wants it to end, and he just out. I mean, look, I mean, I think that everyone should want that to end. It just doesn't look good. It looks really bad optically, I think, for the country to see these guys fighting publicly like that. So I think he wants the public dispute to end. But I wouldn't be surprised to see him really try to calm things down publicly, but under the surface begin to move away some opportunity for Elon's SpaceX and Tesla and to try to have other options because the fact of the matter is for some degree of what SpaceX does, at least, there is no alternative to SpaceX right now. There's potential other companies that could be there, but no one's fully there yet, and they'd have to build that out. So he needs to kind of calm that down. Um, and it's hard to say what the stock reaction will be because the stock will move more on the headlines than anything. Like let's say for example, publicly, and I don't know if this is going to be the way it plays out, but let's just say for example, publicly they resolve their differences. The stock Tesla's going to go higher, and Boeing and ASTS and those other names might go lower. But if he's under the surface, um, trying to provide less opportunity for Elon's companies and more opportunities to others, you're just not going to see that this this quarter or next quarter. You'll see that like in the earnings reports of those companies slowly over time. So the market for the moment is going to move on its guesstimate of what they're able, what they think is going to happen, and they're trying to look forward on the earnings impact or lack thereof of this entire situation that has occurred. I hope that makes sense. From Tate, and is it still worth leaning on OpEx as a potential catalyst to wake up the market to all the bad news, or is that too much of a conspiracy theory at this point? No, I don't think that's a conspiracy theory. We've just seen it happen so many times. It's a market structure event when we have quarterly OpEx, when we have one of these quad witching or triple witching OpExes, especially. It's just part of market structure that you go through a market structure adjustment basically with OpEx. The interesting thing about it is usually the biggest aspect of that market structure change is a huge roll off of gamma, right? The positive gamma levels will oftentimes drop off dramatically immediately after OpEx. But the thing about going into this OpEx is that we didn't get to super hugely positive gamma for the SPX to begin with. So could it still loosen things up? Sure. But it's not going to be doing it from the gamma perspective. So I almost think you need to look at like I wrote into my note this morning. I don't know if anybody reads that. I know I posted like the second I'm about to start talking, but the S&P implied move for the week is 1.91%. Where is that S&P implied move of 1.91% being derived from? It's being derived from the options market. So there are other types of market impact that's coming from options that aren't necessarily 100% gamma that can have that insulating effect. So, just seeing that 1.91%, I just think is notable right now, especially after last week when it seemed like we could not really break in either direction, but positive gamma seemed like it was really low. So we want to just kind of continue to pay attention to all the numbers and not be just fixated on one thing. But yeah, I mean, I think if you can get through or to OpEx or around OpEx, uh, and somehow get a negative catalyst at the same time, a lot of times that's the double whammy that can actually really make us move. But otherwise, the structure of this market has just been incredibly stable and bullish. From David. Hey, Derrick. I think on this past Friday during the morning trading hours, you mentioned AVGO that the 9:50 a.m. 5-minute candle with the upside tail close to the 880 MA. I'm glad you're asking this question. Yeah, this one right here. Love that setup. The upside tail close to the 80 MA with a stock extended at the open was a good area to short for an earnings type of play. Is that correct? Yes, it is. I was trying to remember what you said about it, but I thought you mentioned that was a good area to short. Yeah, so this is one of my favorite trade setups. I don't know why I don't personally do it more. I just think I get so caught up in just position management of everything else I'm doing. Sometimes I don't do it. I love this trade setup. I also really love this trade setup for newer traders. I just because I think it's a relatively easy setup. It's in an in-play name. It can tend to give a really high reward multiple for the risk that you have to put on for it. And we see it happen like with a really good degree of certainty. So basically what the trade is that there's a news event that brings the stock up or down by a large percentage amount. So there's going to be a really large gap there. Oftentimes, but not always, that news event is earnings related. And you get a correction in the other direction of the gap more or less in the beginning of the day. So in this case with AVGO, you had the really big gap down on earnings, massive amount of volatility on that first 5 minute candle. It's not that unusual for an earnings name. And then it begins to kind of resolve itself a little bit to the upside as this ADMA is moving lower. So remember, our 8 EMA is what I consider to be the kind of like the first band of equilibrium on any time frame. So in a downward stock, in a stock that's trading down or trending down, the 8 EMA would be what I call the lower band of equilibrium, and the 21 EMA would be the upper band of equilibrium. A lot of times you see on the first test of the ADMA on a news name some sort of a doji candle, in this case because it was a down stock, an upside tail into the ADMA. And look, it doesn't have to be like this one was like really perfect. It doesn't have to be this perfect. Um, I don't like if it's too shallow. I don't like if it's too far away from the ADMA. I probably won't take it. Like, so for example, if the top of the tail was below 584 and the ADM, sorry, 250, if the top of the tail is below 254 and the ADMA was at 255.50 like it is, that would be too far away from the moving average for me. But it doesn't have to be perfect. It could be a little bit in front of it. It could be on it. Sometimes it overshoots it a little bit, goes like to the midpoint between the 8 and 21 EMA. That's why Tate likes to use a 13 EMA so we can see that midpoint on his trending and fast moving stocks. But basically, into that first band of equilibrium area, you get a pivot, and in this case, an upside tail, and then you short verse that high. You don't just start at the moving average, by the way, when it's still moving up. You don't just shoot it while it's moving up at all and hope that it pivots. You let this thing begin to tail down. You don't necessarily have to wait for the candle to close either, but you want to be shorting it on the way down when at least it looks like it's beginning to form a tail into that equilibrium area. And then you short versus that high. And sometimes you just get like a quick retracement in the original direction of the gap, and that should be enough for you to at least book some profit, at least get your risk covered. And then sometimes you see that pivot actually leads to a new low, or in the other situation where it's the opposite trade, where you get the big gap up and then the pivot low, a new high. And in the situations where you get a new low or a new high, that a lot of times can give really big follow through on that trade. This one, the follow through on it was decent. You did not immediately get a new low, got a decent initial move that ended up being the high of the day, and then eventually you did break lows. This was also something that closed so poorly that if you were short from a good price above 254 and it closed at 247, you could have swung a little bit, made even more money on it today. But it's a trade setup that I love. I see it work all the time. It's in play names, so it can give really good risk reward ratios. And I also think it's um, conceptually easy enough for newer traders to really be involved with. And I almost feel like it's even easier. I know I don't talk about this trade in any of like my training program classes, but I almost feel like this trade is even easier than like the traditional breakout trade that has always traditionally been like the first trade that I would teach to like a brand new entry level trader. So appreciate the question, Dave. It's a good one. I think you should keep an eye out for that trade for yourself. Um, okay. Looks like I got through everything in VVTF for the moment. Let me pop over to the YouTube and see what's going on with our friends over there, if anything. Appreciate everyone telling me that the sound looks good or sounds good. Looks like the buying is slowing. Yeah, so kind of went over that. So it's from question from Cyril. Does it look like the buying is slowing? It looks like the buying is changing, right? That's what I was saying before. It looks like the buying is becoming more short covering than it is new real buying that's continuing to come in. And you can see that with the IWM breakout. You can see that with the workhorse move and similar type stocks. From AR, how are you viewing the intraday relationship between the IWM, the Qs, and the dollar? I'm having trouble 9:30 to 10:30 interpreting their price action. So, uh, um, okay, couple things. The relationship between the Qs and the IWM can be tricky because it's not always the same. Um, it depends a little bit on the correlation levels of the market. So sometimes we're in a higher correlation market, especially when we're getting big moves in short periods of time, like we had in say for example April, where you're going to get the Qs and the IWM that are going to be moving together. The one might be stronger than the other. They're moving together. Sometimes in a more dispersion type of environment where maybe there's really high gamma levels or a little bit more of what we've seen recently, sometimes you'll see, and this is actually it's a great question that you brought up because this is one of the things I was talking about at a certain point in the morning when I was on the VTF radio. I don't remember exactly what I was looking at, but I was looking for IWM trying to form this pivot here at 950, and I was looking at what the Qs were doing and how they moved higher at that point in time, and they were testing highs. So with the IWM, which was relatively strong on a percentage basis, it gapped up more than the SPYs, more than the Qs, kind of continuing its breakout, but pulling back off of its larger gap up into its equilibrium area. Similar but different trade, honestly, to what we were just talking about with AVGO, but at the index level and not necessarily in play. But we had this trying to tail out into the ADMA to be able to push higher. And I was asking out loud, and I didn't know the answer. I was like, if the IWM bounces here, does that mean that the Qs are going to go lower? Or does that mean that they're all going to move higher together? And I really didn't know the answer, to be honest, because, like I'm saying, the correlation between how the IWM and the Qs trade evolves. There were definitely points in 2024 where Qs and IWM were seemingly trading literally opposite of one another, even on like a small of a time frame as a 5 minute chart. One would be moving one way and one would be moving the other way, and they were like it was an extreme dispersion environment, and that was what was happening. This environment we're in right now, I know has got a lot of dispersion, but I'm not necessarily seeing it to that insane degree that we saw at points in 2024 where through a 5 minute chart, the SPYs and Qs are trading opposite of one another. So the first thing I would say is that that relationship is evolving, and you need to understand where we are in the storyline of the evolution. When it comes to the dollar, so I don't look at how the dollar moves or how this UUP moves or how the FX itself moves. I don't look at that on like a minute to minute basis um, with the SPYs and the Qs. And similar bonds, which we know also has a fluid relationship to the indexes. Um, it depends a little bit on the narrative that's around it, right? Because I would say most of the time a weaker dollar is actually good for stocks. Most of the time, the dollar going down is generally going to be good for stocks. It just makes them trade at higher prices, right? Weaker dollar, higher price. But that's not going to be the case if the movement is too fast. If you're seeing like a dramatic sell off in the dollar, that if you go back to April, the big conversation in April with the tariffs was, are tariffs ending US exceptionalism? And one of the things that was so weird about the April sell-off was that stock market sold off, the bond market sold off, and the dollar all sold off at the same time. And you fairly rarely see that. And that was just why the conversation evolved into, wow, they're all selling at the same time. Is this just a result of this trade war having an implication of the whole world just being done with us and it's the end of US exceptionalism or not? That's what created that conversation. So a lot of times the relationship of the dollar and the relationship of bonds to the stock market, the most important thing isn't just how they're changing, it's the speed in which they're changing. And having a very fast move in bonds or a very fast move in the dollar can have a destabilizing in either direction, can have a very destabilizing effect on the S&P. So not necessarily stuff. I don't necessarily watch the dollar tick for tick with the indexes. I do watch the SPYs, Qs, and IWM together tick for tick, but you just got to realize that that's an evolving story. From Gabriel, feels like a small cap summer. Small mid cap names are getting bought up. Weekly charts looking great in many sectors. Yeah, I mean you see it in the IWM. They're going. The question that I am posing that I do not have the answer to at this point is it a small cap summer? Summer implies many months. Or and if it is, that's probably that'd be super bullish, right? It's probably more indication of that rotation effect, which is really bullish. Or is it a short squeeze that's representing a last leg? And that's the big question, right? And I don't know the answer. Only time will tell. But traditionally, what we have seen is when the workhorses of the world and the fuel cells of the world start to run, we're closer to the end of the cycle than the beginning. Whether that means that it's a 3 day move or a 3 week move, I can't tell you. It's too tough. But I appreciate the question. All right, gang. Well, on that note, XBI is getting some life too. Yeah, a little bit. Yep. We were noticing this one last week. On that note, I will wrap things up there with the usual. Have a great night, everybody. It's Monday. I'll see you all tomorrow morning. And that's it. If you're in the YouTube, you know what to do. Tell your friends to come and visit.